Joining us right now to help wade through some of the confusion and tell us what to make in terms of these moves is senior personal finance correspondent Sharon Epperson. And this is a whole new ballgame. Anybody who's been doing this for a while knows there were certain things you used to do. New tax law, though, kind of throws that out the window. So now what?
Well, the new tax law, one of the biggest changes is nearly doubling of the standard deduction. About 30% of taxpayers have itemized. And now with this raise in the standard deduction, some people may not want to do that. There have been other tax law changes as well in regard to the home mortgage interest, as well as state and local taxes. And so those are things that you want to pay attention to. But what's really gone away entirely are miscellaneous itemized deductions.
All right. So what should people do this time around? What are the kind of new tricks of the trade?
Well, one of the things that they should do, and this was true in the past as well, but if you want to look at your home mortgage interest and you want to try to make that extra mortgage payment, you may want to do that before the end of the year. The thing that everyone needs to do is think about how can I reduce my taxable income dollar for dollar. And the best way to do that, as we always talk about, is contributing to your retirement savings plan at work. And so making sure that you've maxed out as much as you can, put in as much as you can into your 401k at work. This is the time to do it. If you're self-employed, open that solo 401k or make sure that you've contributed to the solo 401k as well before December 31st. If you have an IRA, you have until April 15th to make that payment for the 2018 year. But December 31st is the last day for a 401k plan. So that's important to know.
And what do I get in terms of a tax deduction for the money that I put into a 401k or any of these things?
Well, the maximum for 2018 for a 401k is $18,500 or $24,500 if you're 50 or older. And so it'll reduce, yes, if it's a regular plan, you're going to reduce your taxes dollar for dollar by that amount. The other thing to think about is for your taxable accounts, looking at those investments that may have lost you money. And there you want to think about selling those investments to offset any capital gains that you have.
Given how much we've seen in terms of turmoil in the market lately and how many big dips we've seen, that's a good time to take a look at some
Exactly,
losers.
with all of the volatility. In terms of healthcare expenses, you have to have 7.5% of your adjusted gross income in terms of the total value of all of the healthcare expenses you've had for 2018 in order to deduct them. That's kind of a high number for a lot of people. It's going to be even higher in 2019, though, 10%. Wow. So you're going to want to take a look, and if there's some elective procedures you still have time that maybe you could take care of, you may want to think about that if you want to be able to deduct healthcare expenses. Charitable contributions is a huge issue for a lot of people because of the standard deduction being doubled. Some people may say, I'm not going to get the same tax break with my charitable donations. How can this still make sense from a tax perspective? First of all, you don't donate to charity just for tax reasons. But if you bundle those charitable donations and make your 2018 and 2019 contributions, for example, this year, then you may meet that threshold, may want to itemize your deductions instead of taking the standard deduction and may be able to get a tax break.
That's an interesting point, too. I hadn't thought of that.
Yeah.
Any other law changes that we should really think about or people in certain situations should be thinking?
Well, the thing that a lot of financial advisors are talking to me about that they're getting a lot of questions about is whether or not if they have a couple that is looking into divorcing, they should finalize that divorce before the end of the year. And the big issue with divorce changes in terms of the tax law is that alimony payments as of January 1st will no longer be deductible for the person making those payments. And they will be considered taxable income for those that are getting the money.